All right, hello everyone. Welcome back to my channel. If you're new here, my name is Remigius and I am documenting my journey as an upcoming Forex trader. Today, we are breaking down the absolute basics, what Forex actually is and how it works in the simplest way possible. So, if you've ever been confused about currency pairs, pips, or why people trade Forex at all, this video will make everything clear. Let's get started. So let's take it like this. Forex is a short form of foreign exchange, or we can say Forex stands for foreign exchange. So we have a Forex like this, right? So which equals to foreign, or stand for foreign exchange. So that is Forex. So and is the global marketplace where currencies are bought and sold. So which means you can come into the Forex space, buy or sell currency of any countries. And okay, let's think of it like a huge online market where banks, government, business, and traders exchange money. And this exchange, whenever you travel to another country and exchange your currency, this is a tiny example of Forex in real life. Let's say you travel from the Germany to the United States, and in German you spend euro, and by the time you get to United States, euro is not the legal tender there, so you got to change your local currency, your euro, to US dollars, so you can be able to access goods and services in the United States. So that simple activity is a foreign exchange. So you've exchanged your local currency euro to the United States dollar. So it is simply forex. You've exchanged currency. So you see that in trading forex, you have to deal with two currencies of two particular countries in question. You get? So the forex market is the largest financial market in the world, trading over $6 trillion each every single day, each and every single day. So it means on a Monday, there is a transaction of over $6 trillion. Tuesday, over 6 trillion, but just every single day, over $6 trillion being traded on the foreign exchange market. So that's is bigger than stocks, crypto, or commodities combined. So you can see how big the forex market is. Very big, very huge. So as I said earlier, that forex is always traded in pairs. So it means you are buying one currency and selling another at the same time. Now, let's say for instance, you are coming from Germany and you have euro, right? And then you are going to the US, right? You are going to the US and USD. So now this is Germany. Is it? Where's why? This is Germany, and this is US, United States of America, right? So you need to take your euro from Germany, and when you get to the United States, you change your currency from euro to USD. So which means you are buying USD, United States dollars, with the euro you have with you. You don't have USD, but you need to make use of United States dollars in the United States. So you are buying the United States dollars with the euro you have in your hands, right? So that means you are exchanging your euro for USD. So it has to be in pairs. So that is why in foreign exchange market, it is always written in codes. So for someone going from the Eurozone to the United States of America, it is always quoted like this: Euro versus USD, right? Or without the backward slash, just like this: Euro USD. So it means you are selling your euro to buy USD, United States dollar. So that is why it is always quoted in pairs. And for other examples, we still have the Great British Pounds, Great British, sorry, we have the Great British Pounds and the other currency like USD, right? Yeah, we still have pairs like this. Yeah, so pairs like this also exist. Yeah, so to give us Great British Pounds, USD. Yeah, so many you can think of. Great British Pounds and Japanese yen. Yeah, GB and JPY. So now has this currency pair now involves two countries, the Britain and the Japan. So that is why we have a GBP and a JPY, and we also have a USD JPY, which stands for the United States dollar. USD JPY. We have USD. We have AU. Sorry. So we have Euro AUD, which stands for the Eurozone and the Australian dollar. So if someone is moving from the Eurozone to Australia, so you got to change your Euro to Australian dollar, right? So that is why in foreign exchange markets, currencies are quoted in pairs, So, and it is not necessarily it does not necessarily mean you need to travel to the United States or travel to Australia before you trade forex. You can rightly sit in the at the comfort of your home and get involved in the foreign exchange platform. So, in the sense that if you think the first currency, for instance, in the case of USD JPY, if you think the first currency, which is the USD, in the pair will go up in value compared to the second is the Japanese yen, right? So this is the first, and this is the second. Okay, let me differentiate it. This is the first, and this is the second. So this is the first, and this is the second. Sorry. So this is the first currency, which is the USD. If you think the first currency, okay, if you think USD in USD JPY pair will go up in the value compared to the second, which is the JPY, then you buy. So if you think the United States dollar will go up in value, maybe from, let's say this pair now is being quoted as for instance, let's say as 100. So 100 JPY. Let's say this currency now is being quoted as 100 JPY. So which means for you to buy $1, then you need 100 Japanese yen. You will buy $1 or you will exchange $1 with 100 Japanese yen. So, and if you think the value at which you will get $1 will go up, you think you forecast that the value at which you get $1 with Japanese yen will go up. Then what do you need to do? You buy the $1. Mind you, you buy it at 100. You buy it at 100 Japanese yen, and you think that the value will go from 1 to uh that's you buy $1 with 100 Japanese yen. So if the value of US dollar is going up, so which means you will buy the same 1 unit of US dollar with more Japanese yen. So let's say now it will go from 100 to, let's say, 105. You see, So it means the value of USD has increased. So you can no longer get one United States dollar with 100 Japanese yen. So you need to add extra 5 Japanese yen to make it 105 for you to get a unit of United States dollar. So it means the value of United States dollar has increased. So you bought it at 100, right? And when it gets to 105, then you can sell it again. So which means you bought it at 100, for instance, 100 JPY, and when the price got to 105, then you sold it. So which means you get, if you sell that one unit of United States dollar at 105, but you bought it 100, right? So it means you've gained 5. What you gain 5 Japanese yen. So your initial 100 Japanese yen has increased to 105 Japanese yen without leaving your home. Can you see that? I hope you get what I'm trying to say. So the same thing is applicable to all other currency pairs being traded in the foreign exchange market. So, and the same thing, if you think the value of United States dollar compared to Japanese yen will go down, then you sell. Maybe you sell at 105, then when the value gets down to 100, then you can buy. You see? So that is how the foreign exchange market is being traded. So let me remove these things, and let me remove these things and no. Okay, let's take another example with Euro USD, right? So if you buy Euro USD, you are basically saying, I believe the euro will go stronger than the US dollar. So that's just the simplest analogy I can say. And don't worry, as we progress in this video, you get to understand that you get to understand everything I am trying to say. So let's proceed to why price move. So price moves because of some certain factors. Currency price moves because of the following. We have one, because of supply and demand. Supply and demand for the particular currencies in question. It's just like anything else. When the demand is surplus, when we have so much demand of a particular commodity, then what will happen? The price will what? The price will go up. Take for instance, um, Mr. A is supplying what's it called? A cola. Yeah, cola drink. So let's say I'm supplying I'm selling a cola drink, and people coming to buy cola drink from me increase the number, or the number of orders I get on daily basis increase or times 2. Then what will happen? The price of cola will go up. And if I oversupply cola drinks, if there is excess supply of cola drinks and there are little demand, then the price what? The price will come down. That's the basic law of demand and supply. Okay, but what actually affects that? Those are the things we'll discuss on this section. So we have what is known as economic news. We have inflation. We have politics, and we have what big banks buying or selling, and we have market sentiment. Market sentiment. So these are the basic factors that drive price movement on the foreign exchange market. For example, if the US economy releases strong job numbers, the USD might get stronger because investors trust the economy more. You get? Yeah. If any country, if any country releases strong job numbers, which is available to the public, then the currency of that particular country might get stronger because investors, more investors, both local investors and international investors, what will trust the economy of that particular country. So thereby making the currency, the value of that country's currency go up, and thereby in the foreign exchange market, it will affect the currency paired with that country's currency in the foreign exchange market. So it will either buy depending on the position of the currency in the quote, in the pair. For instance, here now we have United States dollar as the second pair, right? So if the value of USD increases, it means Euro USD will what? Will start selling, will go down because the major driver here is the United States dollar. So it will drive the quote, the pair Euro USD to the downside. And if USD is getting weaker, that means Euro will take the lead. Euro will take the lead, which is the first currency, will take the lead as a driver and drive Euro USD as a pair to the upside. So that is how price moves in the foreign exchange market. Now let's continue. Who trade forex? Now who trade forex? Now you might be thinking, who is actually moving all this money? It's not just small traders like us, like me and you. Actually, the market is dominated by big players like big players like the big banks, you know, the central bank, the central banks, the commercial banks, yeah, the hedge funds, those hedge funds manager, and the big corporation, and institutional investors. Institutional investors. So these are the major players in the foreign exchange market. So me and you, we are just we are just retail trader. We are just retail traders trying to get one or two little profit out of the market, you know. So, but these people, they are the big movers. They move price to wherever direction they like. Yeah. They are the big players in the market. So we are just, me and you, we are just retail traders. And we need to trade according to these people. But there is a footprint. Whatever these big players are doing in the market, there is a way we know. So that is embedded in what we know as a strategy. I will come to that later, and it might probably not be in this section, but we will get to that. So once we are able to identify their footprint in the foreign exchange market, then we go alongside with what they are doing. If they are buying, then we will be buying alongside with them. If they are selling, then we'll sell alongside with them. So it is very, very bad. In fact, it's a suicidal mission if these people, the big players, are buying and we sell. It's as bad as suicidal mission. So it's very, very bad. We lose everything. We lose our capital. So we always need to be able to identify their footprint and do what exactly they are doing. That's how we make money. We become profitable traders in the foreign exchange market. But don't worry, I got you covered. We will get to that as soon as we are done with the basics. Now, we now look at what are pips. Pips now. So pip, a pip is the smallest unit of movement in a currency pair. Is a what? A pip is the smallest unit of movement in a currency pair. Let's take our Euro USD as a case study here once again. So if Euro USD as a pair moves from let's say from let's say from one sorry let's say from 100, just for example, let's say it moves from 100 to 101, right? So the unit, a pip here, as stated from the definition, is the smallest unit of movement. Okay, let me put it here. A P is the smallest unit of movement in a currency pair, right? So a pip is the smallest unit of movement in currency pair. So now we have a Euro USD moved from 100 to 101. So a pip here is what? Is 1. A pip here is 1 because that is the smallest unit of movement from 100 to 101. So now another example, if we have 254 to, sorry, 254 to 260. Now pip here, if we want to calculate pip in this movement from 254 to 260, we'll say the pip here is what? That's if we subtract 254 from 260, then we'll get what? We get six, right? So we'll say pip in this kind of movement is what? Is 6 pips. 6 pips. I think you're getting it. Now let's take real examples, right? Let's take real example. Now if Euro USD moves from, say, if Euro USD moves from 1.1 just triple, yeah, to 1.1001, yeah, that is how many pips we have here now. That's from 1.1000 to 1.1001. So what is the pip here? If we subtract the previous move value from, if you subtract 1.1000 from 1.1001, so we get 1. That is a pip. Pips are important because they help us calculate profits and losses. Now we'll get to that. Whole now understand what a pip is, what moves prices in the foreign exchange market. We know what currency pairs is. We know who are the big players in the foreign exchange market, and then we know what actually moves the market. That's the economy of the countries in being the currency, the countries the currency being traded. Yeah, the politics, the news, which is called fundamental. We'll get to that in the course of this tutorial, but probably might not be in this video. So now we now go to what is called leverage. What is leverage? What is leverage? We know what the PP is as the smallest unit of movement in the currency pair. No, now we are going to look at what a leverage is. So leverage, for instance, lets you control a large amount of money with a smaller deposit. It is like borrowing money from your broker. Now, you have $100 US, right? And with leverage, you now have access to control maybe a 1,000 US dollar worth of product or pairs. So you have $100, but you'll be able to buy what is worth a currency that is worth 1,000 US dollar. So it means you are controlling 1,000 US dollar with your 100 US dollar. So it is called leveraging. So, for instance, leverage is usually written in this form: 1:100. So it means if you have $1, you'll be controlling asset worth 100 US dollars. So if you have 100 US dollar, it's going to be 100 times 100, 100 times 100, So we should give you what? $10,000. We should give you $10,000. So that is it. So, but be careful. Leverage increases profits and as well losses. Leverage can increase your profit, and leverage can also increase your losses. Mind you, someone with $100 that is able to control assets worth of $10,000. So it means if you are gaining, if you are getting $1, if you are getting $1 on a norm, then that $1 is will be multiplied by 100. So which means your profit will be $100, right? And as well, if you are losing $1, then your losses will be multiplied by 100, which is $100. So can you see? The leverage is, as they say, is a two-sided sword. So it can increase your profit and as well increase your losses. But if you play your game very well, you trade alongside the big players. You trade alongside the big players, then you will use leverage to your own advantage. Yeah. And how would you be able to trade alongside with the big players? It is what we will discuss. We will discuss it in this channel. Is embedded in the strategy that I will be unveiling very soon. So now we understand what leverage is. We understand pips, right? So can you trade forex? When can you trade forex? Though forex is available to be traded 24 hours in a day and 5 days in a week. So from Monday to Friday, you can trade forex anytime in this within these days. Monday to Friday, you can trade forex. It's available 24 hours a day. So forex is not available to be traded on weekends, Saturday and Sundays, and some public holidays. Yeah, forex cannot be traded or it's not available to be traded on public holidays. Yeah, where uh, not cannot be traded actually, but there was going to be very low participant in the market in the forex industry when these people, when the big players are not in the market, then the retail traders are very small, so cause a significant move in the market. Central banks, commercial banks, hedge funds, corporation, and institutional investors are not are trading. Yeah, because on public holidays, these people, they are not working. They are not operational on public holidays. So the retail traders, their funds, their money is insignificant, to cause a tangent move in the forex market. So that is why it is always not advisable to trade during public holidays. Actually, forex market is open, right? It's open. Yeah. So it's only on weekends, Saturday and Sundays. Forex market is non-operational. So, but aside that, uh, depending on the countries, because different countries different sections. Like right now, time in the United States is different from time in Japan. So they don't lie on the same. Uh, they don't use the same timing, right? So that is why in forex market we have different sections, and the main trading sections are London section, New York section, Tokyo section, and Sydney section. But the best time to trade is usually when two sessions overlap. That's like London plus the New York section. When they overlap, then uh, there's a PDF in the comment section of this video. You download it and it's free of charge. You'll be able to see these sections, the different sections and when they overlap. So that's that for uh, forex trading section. So now, why people love forex? Let's just quick look at why people love trading forex. Forex is popular because it requires very low capital. Yeah, So it requires low starting capital, and it has high liquidity. So which means with your little capital, you can make a lot of money with your low starting capital. There are high liquidity, high volume. Many people are on the foreign exchange market trading. And the third one is it is open. It is open almost all day. So guys, that's it. That's Forex in a nutshell. What it is, how it works, and why so many people are getting into it. If this helped you understand the basics, make sure to hit the like button and subscribe for more beginners friendly Forex videos. Drop a comment if you want me to explain pips, lots, or leverage in more details. Thanks for watching, and I will see you in the next video. Bye for now.